Hi, I'm Sahui. My Marketing of Financial Services presentation will be on Bancassurance. My presentation will cover several points. Firstly, the definition of bancassurance. Secondly, the benefits the insurance company gets from entering the partnership with a bank. Thirdly, the benefits the bank will get. Fourthly, some stats on the insurance market in Singapore, comparing bank insurance to insurer type representatives. It will then be followed by a case study into OCBC's tie-up with Great Eastern, info on product bundling in bancassurance, and ending off with a video. Bancassurance is an arrangement in which a bank and an insurance company form a partnership so that the insurance company can sell its products to a bank's client base. Bancassurance is now a proven model in Asia, and there have been several successful partnerships such as the region-wide partnership between Prudential and Standard Chartered, where the bank, StanChart, delivers Prudential's life products on a preferred basis. The partnership was renewed in 2014 for an additional 15 years. There are other such examples, such as partnership between DBS and Manulife in 2015, and the partnership between Citibank and AIA in 2013. So, what do banks get out of such a partnership? Well, banks can make optimal use of their resources in their infrastructure, being their people, branches, and systems, leveraging upon them to deliver maximum value to their clients, thus increasing customer loyalty and profitability. Banks will also gain access to a wider range of products that they can sell to customers, and while benefiting from the resources and knowledge of insurers. They can also generate commissions, miscellaneous fees, and upfront payments from insurers, thus making this business a very profitable one. The upfront fees are really big too. For example, in the DBS and Manulife deal in 2015, Manulife paid 1.2 billion US dollars upfront. And in the partnership between AIA and Citibank, it also has AIA paying an upfront fee of over $1 billion to Citibank. Banks will be able to enhance their product offerings by adding insurance to their list. With the added offerings, a bank will be able to provide for more specific needs and create products that are suited to each customer's financial needs. With the disruption from fintech and strict regulations, a broader offering of competitively designed insurance products can help a bank boost itself in today's economy. By providing more products and comprehensive coverage of customers' financial and insurance needs, banks will be able to provide greater value and service to customers of the bank rather than those who do not provide such services, thus improving customer retention. Why would insurers want to enter into a partnership with banks to sell their products? Well, instead of hiring more salespeople, insurance companies can then tap into the sales capability of the bank to sell their products. Insurers can then take advantage of banks' high market penetration rate and establish banking relationship with their clients. The slide below shows some data on the insurance market in Singapore, more specifically the number of policies sold by each of the segments of the market in the year 2015 and quarter 3 of this year. And the segments are basically type representatives, which are insurance agents from each of the insurance companies, bancassurance, financial advisors, and other channels of distributing insurance. The insurance market is still dominated largely through type representatives with insurers, while bancassurance maintains its market share at 13%. As can be seen in the pie charts, there's a difference in the market shares of policies sold and weighted premiums. In weighted premiums, even though type representatives managed to hold the largest market share at 36%, they were overtaken by bancassurance in 2017 with a market share of 41%. Moving on to our case study of OCBC. OCBC is one of the largest bancassurance providers in Singapore. They started their bancassurance business way back in 1992, and they collaborate with Great Eastern. Banks and insurers have different expertise. By leveraging on each other's strengths, OCBC was able to identify customer needs and could target customer segments with comprehensive insurance product developed by their partner, Great Eastern. An example would be their Mortgage Protector Plus policy in 2010, in which OCBC was first to offer. It was a huge success. And also by working closely during application process, OCBC could speed up the time it took for the underwriting process to take place from a month all the way down to a week. This huge shortening in time provided OCBC with a competitive edge in the bancassurance business. Product bundling is a common method of selling insurance in banks. It works by combining banking and insurance products together to serve a particular purpose. Common products combine investment plans with life insurance, such as, for example, Standard Chartered PruSave Limited Pay.
Well, one sales advisor was under such pressure to hit targets that he sold the financial products he was supposed to be selling to customers to himself, his wife, and a colleague as well. Lloyds has now been fined a record £28 million over the incentive culture that drove staff to mis-sell financial products for fear of being demoted or losing pay. The Financial Conduct Authority also found that some staff had received bonuses even though all their sales were unsuitable. Our business correspondent Sarah Smith reports.
There are some big decisions we all need a little help with.
But if you went to Lloyds TSB to get that help, staff were more likely to be helping themselves. The Financial Conduct Authority has fined them for serious failings. £28 million is the largest fine ever imposed for bad retail conduct. More than 1 million products, including individual savings accounts and income protection insurance, were sold to nearly 700,000 customers of Lloyds, TSB, Halifax and Bank of Scotland.
As you have seen from the video, banks need to take care to prevent mis-selling. Banks should set realistic sales targets so as to avoid inadvertently forcing staff to mis-sell products to clients.